Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Oops. And if you guys are looking for undervalued investments, opportunities, click subscribe. In this clip, I know we've got a lot of people. We've got inflation, deflation, housing starts, ratios. What I want to do is I want to tie this all together. All right, I'll tie it all together. I don't think I've done a clip like this. I'll describe what inflation is, what deflation is. I'm gonna show you some data. We're gonna do some copper to gold ratios. They call it Dr. Copper. We're gonna look at treasury yields. We're gonna look at housing starts, monthly inventories. We're gonna for real estate. We're gonna look at the real estate cycle, and I'm gonna try to tie this all together. So this is gonna be off the top of my head. Try my best. So money gets created from a blank checkbook. What happens is this money gets created at the Federal Reserve and a bond is released, a bond at interest, and the swap occurs. So a government issued bond, a treasury bond, goes to the Federal Reserve. The Federal Reserve writes up some numbers or electronically sends it over. They get the bond, and then that bond has to get paid back with interest. Someone has to buy the bond to create the money out of thin air. That money goes into existence, and you are left with a conundrum right off the bat. Here's the problem with the money system. I loan $1 out, but that dollar has to be paid back at interest. There's interest tied to it. Where does the money to pay the interest exist? It doesn't exist. So you have to continually increase the money supply just in order for the money supply or the money system to survive. It has to be in an inflationary system where the debt continues to pile on because there's no way to pay the debt back. That money doesn't exist in the system, the interest payments. And then that interest keeps blowing up and you have to borrow more money into existence to keep the whole thing going. So that's problem number one. But how to get inflation and deflation? Inflation is simply the expansion of it's just the increase in the money supply. It inflates larger. Higher prices are a symptom of inflation. So to say it another way here, all right? If you have prices go up of everything, is it possible for that to happen if you don't increase the money supply? It's not possible. You can't have everything go up in price at the same time and not have a corresponding increase in money supply. What would happen is you'd have one price go up at the expense of somewhere else going down. And potentially it would be a net zero. You would have zero inflation, but money would be rotating from sector to sector within, because if one sector gets supply demand goes unbalanced, it goes up, this one has to go down. It has to draw currency from other areas. You can't have inflation in prices without inflation of the money supply. You have to inflate the money supply for prices to all go up in these sectors. You can't have them all go up simultaneously without an increasing rate of money supply. So that's inflation. Deflation is the opposite. It's not declining prices. Declining prices do not wreck a system. Declining prices are great for consumers. You can buy more of whatever you want. Technology lowers prices. We become more efficient at building products. That's an efficiency gain. It's not real deflation. Prices go down, prices go up. That's not deflation and inflation. Those are symptoms, potential symptoms of inflation and deflation. Deflation is when credit is destroyed. So credit needs, you've got this boom on the front half of an expansion of credit is a boom. And then the back half, you have a deleveraging or a deflation, which is a destruction of credit. The destruction of credit is literally destroying or deflating the bubble and credit before it. So we have an expansion phase, and then the bubble phase, and the deflation deleveraging. So things leverage up and they deleverage on the backside. Money goes into the system. It goes in as base currency, the majority of money. That comes from the Federal Reserve. It goes into the base money system, into the banks. The banks have to loan that into existence. Over 50% of their loans goes into residential real estate. So in order to get the money that's locked in these banks, you have to have a real estate boom. That's what creates the expansion of credit, the boom. You have to have the boom. That's how the money gets into the hands of people. That's how you get inflation, which is demographics driven. So money gets created. There's no way to pay this money back. You have to continually inflate it. It goes into the banking system, and we have to loan it into existence. That's where that fractional reserve lending goes in. We loan it into existence with residential real estate. Residential real estate has cycles because we overbuild, we underbuild, and that is where you have inflation and deflation, is on the real estate cycle. So I'm going to pull up a chart here. It's behind me right now. I'm going to shrink myself up. Those are the expansion. So we've got the recovery phase, expansion phase, hypersupply phase, and recession phase. This is the real estate cycle right behind me. What does that mean? The recovery phase is when you are coming up and you're building more homes, but you're still below the long-term occupancy average. This is 1.3 million homes or so. An expansion phase is when you're building new homes and you're going above the 1.3 million per year average. So if you're building 1.5, if you're building 2, you're in an expansion phase of real estate. That expansion phase of real estate is inflationary. Why is it inflationary? Because you're going above the average, you're creating homes, and those new homes have new loans put against them. That is expansionary because that loan didn't exist in the first place, and now it's 100% against this asset in the world. So that loan was 100% expansionary when they loaned it against that new asset. And in an expansionary phase, real estate is going up in price. We have a supply-demand imbalance. That supply-demand imbalance means that real estate is going to go higher. If it goes higher, they're making larger and larger loans against existing residential real estate and against new homes. It's a double whammy. It is inflationary. That's what it has shown in the history and in the past. And I have a feeling that that's what's going to be in the future. Then, we're still in this real estate cycle, right? Look on the right-hand side. We've got this hyper supply phase over here. What happens is they build too many homes. And what happens? We see inventories go up. We see prices of real estate go down. Demographics can also affect this. And we go into a hyper supply phase. That is deflationary because it's going to crash. Prices are going to crash down. We're not going to buy new homes. We're not going to build as many new homes, and it all crashes down. We are not inflating the currency supply anywhere near an expansion phase because it's all crashing down. So credit gets destroyed, and we're not loaning as much. It's a double whammy. It is deflationary. And then you go back into a recession. That's the recession when everything collapses, and then you go back into a recovery phase and it starts all over again. So when these guys talk about inflation, deflation, I don't think they know this. They probably don't know this at all. And the way that I stumbled upon it was just looking at housing starts and the cycle of housing starts and where all the recessions were. And they were all at the end of the housing starts going down, which means everything was collapsing in real estate. That was the driver of everything. The driver of inflation, the driver of deflation, and it had these blowout recessions. And real estate was the driver of it all. It was that cycle. Now, what gives us indications that we're in a hypersupply phase and that a recession's coming? How can we see it? I've got some stuff behind me. You'll lose me. And there's a couple things I want to go over too. So first, we'll go big here. Go big or go home. Copper to gold price ratio. Dr. Copper. Notice that the 10-year, this is Canadian government bond yield, Canadian or US. It's the same thing. I just grabbed one, didn't even look at the Canadian. They both mirror this. But the 10-year yield mirrors basically and is slightly delayed behind the 10-year or the copper to gold ratio. This ratio falls out, usually that falls out. Goes back up, this comes back up. Copper to gold price ratio it leads everything. So in a crash, if you see the copper to gold ratio just bomb out, that's when you got to start to worry. You got to watch it. Then you're going to see your 10-year yield drop, which means people are looking at the copper to gold ratio. Then they take action and they run to safety, which is into bonds, and yields drop. Here's the copper to gold ratio right now. We are moving on up quite substantially. And we've been moving up. It's got a little bit of a pullback here. But right now, we're probably going to see yields go higher. We have a little bit of a pullback here. So yields probably pulled back. Oh, look at this. Here's yields. 10-year yield moving on up from August of 2020, April of 2020. So it is delayed a little bit. It is delayed. It moved on up and we're moving sideways here. Same with the copper to gold ratio, moving sideways. I don't see how copper's not going to go higher. And the reason is we're using it in everything. India is building out its infrastructure so they have electricity, period. China's using copper. We're going to build electric vehicles. It all uses copper. Everything uses copper. Renewable energy. So I don't see how copper's not going to go higher, and I don't see how copper's used in real estate too. So there's the 10-year yield. So if you see this drop, if you were to see a big drop like this right here, see how this blew out in February? This big drop right here, that was before COVID. And what happened to COVID? This Dr. Copper said something's wrong. It's selling off, like just hardcore sell-off. And then later stocks fell in March. And Dr. Copper said something's wrong. It's sold off. Here's your leading indicator right there. It was even dropping before this, signaling that problems were happening. Problem. We've got a break of this uptrend line, a back test. If you drew a line in here, came through, back test, and then dropped. This drop is a problem. Look at this. In February, right here, right before March, yield started to tank. We broke out of this bottom. We broke out of this pattern here, came down. I was like, oh, something's wrong with yields. Sell out of everything. It's tanking. Something's going on. The market knew it too before COVID shutdowns and all this other stuff and the huge crash. So yields tell us it. Copper to gold ratio tells us it. Here is the new privately owned housing unit starts. We are moving on up into an expansion phase. This is the shutdown that they created of the housing units going down. Short-lived blip. It's a non-structural event. We are moving on back up into an expansion phase of real estate. Now, here's something on real estate. And I know people, they look at demographics, and they look at demographics incorrectly, apparently, some of these channels. We are in an expansion phase of real estate. Right behind me. That way, yeah. That way, down there. Expansion phase of real estate. There's a reason we're in an expansion phase of real estate. The demographics have to support it because we're in an expansion phase of real estate. Now, if you look at the next slide, I'm going to put months of inventory up. Actually, let's go right into it. Here's months of inventory. Right there. We're at 1.9. Now, this was the COVID area in here. We were at 3 before it. It was declining already. We already had the demographic buying the living heck out of it. We were already in an expansion phase of real estate. We were already moving with higher prices in real estate. COVID didn't do anything. COVID shut it down. We had months of inventory go up, and then we sold them all back off right into 1.9. This 3.0 was going to come to 3.0 here and go back down. COVID just delayed it, and we had a little bit more inventory. It delayed it. It didn't stop the structural move. We have more millennial home buyers. The average age of the new first-time home buyer is 34. Do plus or minus 6. So the millennials basically is 40 years old, all the way down to 28. Look at that demographic. Look at the demographic. You can see the demographic. You know what? I'll pull it up. You guys convinced me to pull this thing up. USA demographics. I think Wiki has a good one. There it is, right here. Here's the demographics of the United States, right there. It's right behind me. Lose me. This is what it is right now. See how this comes up? The baby boomers, right here. This is the baby boomers. This is the 1970s. They blew this thing up because of the increase. And then we decreased a little bit in this disinflationary Gen X area. 40 years old, right here, we go up all the way to 28 years old. The demographic in this area is greater than the demographic in this area. If you were to look for females and males, that is going to put upward pressure on prices. That's home buying years, 34. So 28 to 40, 34 being the average. Go look it up if you don't believe me. The demographics right there support, they're all in home buying years. Now, the only thing that I didn't look at is what is the percent. I think we were at all-time lows for home ownership, which is perfect. That's what we want, because that means more people are going to come in and buy homes. So we've got the demographics supporting a higher real estate price. What does this mean? I went through and I talked about loaning money into existence through real estate, residential real estate. It's over 50% of their loans. If we have a residential real estate boom, which we can see we're having in an expansion phase, we're in an expansion phase of real estate here, means more loans, more people, more new homes need to be built. Inflationary. That has to reverse. Now, what's the leading indicator of this? Inventory. Inventory at all-time lows of 1.9 months. That has to reverse for it to be deflationary. That doesn't reverse, or even if it reverses and stays below like 3 or 4, it's game on. It is game on when it's below 4. That's all-time low. Now, these guys that are talking about deflation and a housing market crash, they're on crack. You can't go from a 1.9 months of supply of inventory to a crash. The crash last time went to 10 months of inventory. And it happened the year or two before it crashed. Inventory was going straight up, went all the way and kind of peaked at about 11 months, 10, 11 months of inventory. We're at 1.9 and we have no homes to sell. We are done. In Colorado Springs, we went up 28% in prices April of 2021 versus April of 2020. 28%. We have 9 days of homes being on the market is the average days. 9 days. We have no inventory. It's like 0.3 months. So the real estate cycle is in an expansionary phase. I'm going to pull this up. An expansionary phase. Going back, we're hitting our charts up. We are here. We're in this phase up here. Declining vacancy, new construction's happening. That is inflationary. We want to be in commodities in an expansion phase. The recovery phase, that is stocks. Stocks, we just came from recovery phase. That's where stocks do very well. Low interest rate environment, low inflation environment. You want to be in the companies that consume commodities. The next phase, an expansionary phase of real estate, inflationary, higher interest rates. Now, how does that work, right? How does interest rates work? Let's go into it. So, this is what happens with interest rates. We go into an expansionary phase of real estate. They loan more money out. We get inflation. Inflation then puts pressure on bonds, because as inflation goes up, let's say we have a 3% inflation rate and the bonds are at 0.6% at the bottom of COVID. No one wants to hold a bond if you have a real negative rate. You're going to be losing money because the inflation rate is greater than what your bond is paying. So what happens? They sell bonds. They sell bonds and interest rates go up. What causes interest rates to go up? Inflation. Real negative rates causes bonds to go up. Now, as inflation goes up, interest rates will chase it higher. That difference between those two, which is the real negative rate, if it's growing, meaning that we're getting greater inflation as time goes on, gold and silver take off. It's a greater real negative rate. Gold and silver love that. They love it. That's the conditions for commodities, but mainly for gold and silver. Commodities, if you just have inflation, will go up. People are going to rotate their money from higher interest rates. They're going to sell bonds. They're going to sell stocks, because why would they sell stocks? Stocks have a PE ratio. It's a price to earnings ratio. That price to earnings ratio expands, and people are willing to take on more risk when interest rates go low. So they try to find yield anywhere. Returns, yield, they speculate more. When interest rates go up, they don't need to speculate to get that yield, because yields are going up. That yield is going to calculate the net present value of growth stocks differently. So when you look at stocks, their PEs and high interest rate environments contract. So they're going to have very high earnings, very high, just to remain flat as their PE ratio compresses. So stocks are not the spot to be in an inflationary environment, because interest rates are going to go up. If interest rates go up, their net present value calculations go down and their PEs contract. PE ratios, contraction. You don't want to be there. You want to be in commodities and precious metals. Now, that's the expansion phase. I've shown you what to look for. If you have a housing starts decline, that's like ding, 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 something's wrong. Your copper to gold ratio just starts to decline. And then your yields decline. Crash is game on. It's coming. Get out. Those are your leading indicators right there, those three. Now, what's the leading indicators of real estate and the housing starts and all that? Inventory days on the market. Those two. We are all-time lows for inventory. This stuff's not going to swap. It's not going to turn in a second. We're going to build more homes when lumber gets cheaper or whatever. We got to build them. We have to build them. It's inflationary. Inflationary because that's the gateway for the money to get into the system. So when you look at investments and you say, where should I put my money? Expansion phase, commodities, precious metals. It's that simple. And real estate would be a good one too. Hypersupply phase, bonds and cash. Because we're gonna go into a recession. We go in that recession, we're in bonds and cash. Interest rates will drop. They are going to drop. Now, inflation is met with higher interest rates. That means a real estate market goes up in an increasing interest rate environment, not the opposite. Interest rates fall when you have crashes, when you have problems. People run to bonds. They don't run to bonds in a high inflationary environment. They run away from bonds. That's why interest rates go up. They run to bonds when you have problems. So if you're in a hypersupply phase and they see that the real estate market's about to crash, they're like, oh no, this is looking bad. They go buy bonds. What happens when you buy bonds? The demand for bonds go up and the yields go down. You see the yields go down and you say, oh man, we're going for a crash here. You get out. You get out, you buy some bonds, you make a little bit of money on bonds on the crash, and then you rotate into stocks in the recovery phase, because a recovery phase has low interest rate environment with low inflation. P ratios go through the roof in that type of environment because people are willing to speculate. They can't get money in bonds. Everybody's already there. That's how this cycle works. And here is, if you were to look at the long-term M2 money supply growth versus inflation, all of these movements in the M2 money supply correlate very well with the real estate cycle. All these things. And this is minus 10%. We haven't really had deflation ever. So all you guys that are worrying about deflation, we haven't had it since 1940 something. It's not even on this chart. We got it here at 0, and we've got 2 other times at 0 in the 90s, and that was it. We didn't even hit 0 in 2009 crash. Now, the M2 money supply can go up from 2000 because they started doing all this QE stuff. So what they did is they started printing a bunch of money in 2000, 2009, and all this other stuff. They started printing a bunch of money a little bit after 2009. And someone might ask the question, how come the M2 money supply went up and inflation didn't? Because they're not loaning that money through real estate into the economy. We're in a recovery phase. There's no way to get the money into the hands of people. You have to be in an expansion phase. If you look at all the expansion phases, that's when you have commodity booms and when the dollar declines. Dollar declines in expansionary phases because money's coming into the system. Commodity prices go up because they have an inflation component they're priced in dollars. It's an inflation component. When the dollar goes way down, price of commodities go way up. And it's an inflation hedge. Hard assets. Now, here is the CRB Index. CRB Index. This is the commodity index, all right? We were in 98. 98 was the bottom. 98 was flashing a buy signal for commodities. All the ratios were buys. They were buys on oil, copper, everything. CRB index to stock ratio, everything was screaming buy in 98. And look, you could have bought at the bottom of 98. And guess what? You would have killed it. Because you would have ridden it up, come down a little bit, and gone on up. Now, how do you know that you shouldn't have sold? This was a big decline here. This is a good 20, 30% decline. People would have gotten scared out. Why wouldn't I get scared out? What are we looking for in this commodity boom right here? We're looking at an expansionary phase of real estate. So if you looked in the 98, 2000, 2001, 2002 era, let me pull this up. This was what? We came up, 98. It was coming back a little bit, and it went sideways and was still heading up. If you looked at the inventory was solid on real estate. It was not increasing dramatically at that time. Game on for real estate. We're using inventory numbers for real estate, and we're using days on the market. And our price is still going up. If prices are going up and the days in the market are still good and the inventory is still good, we stay. This is our leader. This is our indicator. Real estate. Real estate, real estate, real estate. It tells us a lot of things about everything. So here's a commodity, pulled on up, and it went from 150 all the way to 400 and something, maybe even 500, because it's kind of a funky chart up here. That's a big move. And if you're in those companies, man, they moved huge. And then we went into 2008 was the crash. So we had a crash in like 07, 06, 07 of housing starts. Inventory went through the roof to the upside. Get out. Get out of there. And then we crashed on down. And then we were in a recovery phase. Recovery phases aren't great for commodities. They're going to continue to head lower. Low inflation, low inflation and low inflation. Not the spot to be. So when we go down here, this is the S&P 500. Since 2009, we were in a recovery phase all the way, I would say, to about here, actually. So this was basically the market move. Commodities started to kick up. We were starting to get a little bit more home price movement, but we were still in a recovery phase. And the recovery phase lasted, I'd say, till about 2020. We came on down. Now, that doesn't mean that stocks are just going to crash out. There's still good things about stocks, but I think they're going to underperform commodities because commodities are so cheap and we're coming up in this new environment where I think it's going to be inflationary because of real estate, where we are in that cycle. It's going to be inflationary. Inflation, higher interest rates. Higher interest rates, stocks don't like it. So that's kind of the entire system there. You can't get deflation. Deflation comes from real estate, like those blowout deflations. The 1929 crash. Did you know there was a real estate bubble right before it in the 25, 26 timeframe? It was peaking out in that 25, 26. And then a year or two later, a couple of years later, it blew out the stock market and they had leverage loans. There was leverage all over the place in the 20s. Leverage in real estate all over the place, bunch of easy loans, and then we had leverage in the stock market. Now, I don't think we're going to have a crash in real estate till 2028, 2029. And I don't know what it's going to look like. It may not even be a big crash. I don't know yet. You got to watch this stuff. But I highly doubt that we are going to turn on a dime from all-time record low inventory to a crash. We have not seen that in history. These guys who are saying it, maybe they know something I don't know. Maybe they know a bunch of homes are going to come on the market. And even if they do, I'm not 100% sure that it's going to be that bad. Because we have a huge shortfall in homes right now. A huge shortfall. And we're just exchanging ownership at that point. Those people still have to live somewhere. You're still going to have to rent something. You're still going to have to go somewhere. So that's the cycle. Real estate's the driver of it because it drives interest rates. And interest rates drive the rotation of money between asset classes. Stocks, bonds, commodities, how do they go up? How do they go up in price? Is it earnings? No, not earnings. Earnings don't drive stocks higher. Money flows do. Money flows. You need to know where money is flowing. Is it flowing into the stocks that you own, or is it going away from the stocks that you own? If money's flowing in, you go higher. When the dollar gets weaker and interest rates go up because of inflation and dollar weaker are the same thing. So when I say dollar weaker, it's inflation. So when you have inflation, you have higher interest rates rotates money. Where's that money going to rotate into? It's going to rotate from stocks and bonds because of the reasons I told you before, and move into commodities and precious metals. That money rotation, the money flows, is what pushes assets up. So if you've got assets here, two different asset classes, this one goes up, it's drawing currency from this one that goes down. Ratios. If this is low, if this has never been this low, it's through the ground over here and stocks are up here, what do you think is going to happen when interest rates go up? It's going to go to the opposite direction. Money's going to flow from bonds and stocks into commodities and precious metals. The money is going to flow. That money flow is what changes prices. That money flow changes ratios. That money flow draws currency from one sector to another sector, and it does this. Now, if we're down here and this is way up here, we are going to rotate over time, is my guess, because interest rates. And with interest rates going higher, people are going to say, I don't want my bonds anymore. I don't want stocks. I don't want to pay a PE ratio when the interest rates are going up. I want to go into commodities because they're going higher. And then everyone's going to chase into commodities. It just takes time. That's how things work. Earnings don't drive stocks higher. I know they do on the long term. Money flows. How money rotates between sectors really is the driver. And what drives the money, the rotation of money? Interest rates. What drives interest rates? Inflation. And what drives inflation? Real estate. That's it right there. That is the progression. If you guys like this content, give me a thumbs up. Appreciate you guys listening. If you guys have any questions, put it in the comment section. Love to hear your opinions. And thank you for watching. This is Finding Value.